We have officially entered the acceleration phase. For months, the warning signs were clear to anyone willing to look past the surface-level price action. The suppression of the silver market was becoming mathematically impossible to maintain. The paper structure underpinning the price, particularly the massive volume of futures contracts on the COMEX, was operating on borrowed time. The system depended on confidence, liquidity, and the assumption that physical demand would never force a reckoning. That assumption just failed. When physical reality finally asserted itself, the move was never going to be gradual. It was never going to be orderly. This was not a market that would gently trend higher. This was a market primed for a vertical repricing event. And today, Monday, January 12th, 2026, that vertical move began. Look at the intraday chart. This is not a normal trading session. This is not organic price discovery. This is a liquidation event. Silver surged to 85.37, a gain of more than 6.7% in a single day. But the percentage move is not the story. The real story is how we got here, and why this move is far from finished. To understand the violence of today's action, you have to go back to the bear trap that was set just days ago. On January 9th, the banks executed a classic maneuver. They smashed the price down to $74, triggering stop losses, flushing out weak hands, and forcing over-leveraged retail traders out of their positions. The goal was simple: convince the market that the rally was over, convince participants that silver was headed back to $60. But that drop wasn't the end of the move. It was the fuel. Every short seller who piled in at $74 is now underwater by more than 11 per ounce. They are trapped. And today, that trap snapped shut. From the moment the market opened on Sunday evening, the message was clear. Silver gapped up from 80 to 82, an aggressive move that left empty space on the chart where no trading occurred. In technical analysis, gaps like this are signs of urgency. Buyers were not waiting for pullbacks. They were not negotiating. They were hitting the buy button at whatever price was available. That behavior continued throughout the overnight session. The chart shows a staircase pattern: up, consolidate, up, consolidate. This is not retail behavior. This is institutional accumulation. This is the footprint of sovereign capital or massive industrial buyers patiently absorbing every ounce that came to market. They weren't chasing candles. They were building positions. They were soaking up the float. But then, at precisely the moment New York came online, patience vanished. As U.S. markets opened, the algorithms immediately recognized the problem. Prices in Shanghai were dramatically higher. The U.S. market was mispriced by nearly $8. That realization triggered a panic chase. Volume exploded. Silver ripped through $84 without hesitation and didn't stop until it hit $85.32. Look closely at that final candle. There is no upper wick. It closed at the absolute high of the move. In technical terms, that means there was zero selling pressure. Buyers were willing to pay the highest price on the board just to get exposure. That is not confidence. That is desperation. This is what a commercial short squeeze looks like in real time. Banks that were short at $74 are now facing margin calls in the billions. At this stage, human decision-making is no longer in control. The clearinghouse computers have taken over. Their only instruction is to close losing positions at market price. They do not care whether silver is trading at $85 or $95. They care only about neutralizing risk. However, this is the moment where discipline matters. When markets move this fast, volatility expands. We are now in an environment where a $2 or even $3 move is noise. The banks will attempt a counterattack. They will try to engineer a flush. A drop back toward $82 would not invalidate this move. It would be a textbook backtest of the breakout level. Previous resistance becomes support. Moving averages catch up. That process is healthy. The danger is waiting for a dip that never comes. In true supply crises, markets do not always retrace. Sometimes they go limit up. When that happens, trading is halted because prices are moving too fast for the clearing system to calculate margin requirements. If silver locks limit up, you cannot buy. You are frozen out while the train leaves the station, and you are left holding depreciating fiat currency. This is why the $85 level matters. Above $85, losses for the commercial shorts stop being trading losses and start becoming solvency issues. This is the point of no return. That is why the battle here is so violent. The banks are not defending a trade. They are defending their balance sheets, and the chart is telling us they are losing. The trend is now exponential. Every dip is being bought faster than the last. The old paper game relied on flooding the market with contracts to cap price. Today, the market absorbed that paper and kept rising. The paper is burning. The physics of supply and demand are taking over. The technical verdict is clear. The $80 ceiling has been shattered. The $74 bear trap has been sprung. And $85 is now the new battleground. But charts only tell us what already happened. To understand why this is happening and where price is being pulled next, we have to look across the ocean. we have to look at the magnet driving this move. While American traders are fixated on $85, the real price, the price that actually matters, is sitting nearly $8 higher. The Shanghai Gold Exchange closed its afternoon session today with silver priced at $93.31. Let that number sink in. This is not a futures contract. This is not paper. This is the spot price for physical metal in the largest manufacturing hub on Earth. And it creates one of the most dangerous distortions in the global financial system. There is currently an $8 spread between the price of silver in the West and the price of silver in the East. In a world where high-frequency algorithms fight over fractions of a cent, an $8 spread is not an opportunity. It is a vacuum. It is a black hole that pulls material into it with irresistible force. This is the arbitrage vacuum. Here's how it works. If you are a global bullion bank or a trading house, you see silver sitting in a New York vault priced at $85. You see buyers in Shanghai bidding $93 for immediate delivery. The trade is obvious. You buy the metal in New York. You ship it east. Even after transport, insurance, and security costs, you are locking in $6 to $7 per ounce risk-free. That trade is happening right now. Every available ounce in London and New York is being palletized, wrapped, and shipped east. This is draining liquidity from Western markets at the worst possible time. COMEX inventories are already at historic lows. Now they are bleeding out to feed the Shanghai premium. Western banks have only two choices. They can allow this arbitrage to continue until vaults are empty, at which point they face force majeure and contract default. Or they can raise the price in New York to close the gap. That is why $93 is the magnet. The price in New York is not rising because of speculation. It is rising because it is being pulled. It has to rise to stop the bleeding. If silver remains at $85 in the US, Western inventories will be gone in weeks. This is the remonetization of silver, and it is being led by the East. For decades, price was set in London and New York using paper derivatives. China was a price taker. That changed today. China is now the price maker. They are bidding aggressively because they need physical metal for solar panels, electric vehicles, and strategic reserves. They are willing to pay a premium to secure the atoms. New York is now the price taker. The vertical candle we saw this morning was not speculation. It was the U.S. market realizing it was priced too low. It was a game of catch-up. And this catch-up has only just begun. The game is not over until prices converge. That is the rule no one on Wall Street wants to talk about, because convergence is not optional. It is not a theory. It is a mechanical process. As long as silver trades at materially different prices in different parts of the world, capital will move, metal will move, and pressure will build until that gap is closed. This is why even a pullback in New York does not change the outcome. If the banks manage to smash the paper price back to $82 tomorrow, the floor does not break, it hardens. At $82, the arbitrage gap does not shrink. It widens to more than $11 an ounce, and the wider that gap becomes, the stronger the incentive to move physical silver out of Western vaults and into China. The drain accelerates. This is the trap the short sellers are in. If they smash the price, they lose their inventory. If they allow the price to rise, they lose their capital. There is no escape route. There is no clean exit. Every move they make worsens the other side of the equation. And that leads us to the most important question of all. Why is China paying $93? Why are buyers in the East panic bidding for physical silver while the West is still debating whether $85 is too high? The answer is inelastic demand. China is in the middle of a structural economic pivot. The era of speculative property growth is ending, and the country is reorienting toward high-tech manufacturing. China dominates the global solar panel market. It dominates battery production. It dominates electric vehicle supply chains. And every one of these industries depends on silver. Not optionally, not marginally, fundamentally. Silver is not a luxury input. It is not a cost that can be substituted away. Without silver, these factories stop. Production halts. Contracts fail. Workers are sent home. Entire supply chains break. And the stockpiles are gone. For years, the global silver market operated on a just-in-time supply model. Inventories were lean because price suppression discouraged hoarding. Why tie up capital in metal when paper markets told you there would always be more available tomorrow? That assumption just collapsed. Chinese manufacturers are no longer operating on just-in-time. They are operating on just-in-case. They are hoarding. They are securing future production now at almost any price because the cost of not having silver is far greater than the cost of paying a premium. If a solar manufacturer in Shenzhen believes silver could be $150 next year, paying $93 today is not speculation. It is survival. It is locking in raw materials before competitors do. And that behavior creates a price floor made of concrete. You cannot shake out a buyer who needs the metal to keep their factory running. If the price drops, they do not sell. They buy more. This is the critical distinction between a speculative bubble and a physical shortage. In a bubble, people buy because they believe they can sell to someone else at a higher price next week. In a shortage, people buy because they intend to use the asset. They are not price sensitive. They are availability sensitive. That makes the Shanghai price the real price. The $93 level in China reflects physical reality. The $85 level in New York reflects paper abstraction. The gap between those two numbers is not noise, it is opportunity. But that opportunity does not last forever. There's another layer to this move that most analysts are ignoring, and it may be even more powerful than industrial demand. Currency defense. The global order is fracturing. Trust in institutions is weakening. Chinese citizens are watching their property markets deteriorate in real time. They are watching wealth evaporate, and they are looking for somewhere, anywhere, to protect what they have left. Capital controls make it difficult to buy dollars, so they buy gold. And when gold becomes too expensive, they buy silver. The Shanghai premium is not driven solely by factories. It is driven by households voting against their own currency. It is driven by savers seeking a store of value outside the financial system. And in doing so, they are breaking the Western suppression mechanism. The paper silver market was never designed to withstand coordinated physical demand from both industry and the public at the same time. That is the nightmare scenario for short sellers, and it is now reality. So when you look at your screen and see $85, do not think expensive, think discounted. Silver in New York is trading below the global clearing price. You're being offered metal cheaper than what Chinese manufacturers are paying. That window exists only because the paper market is lagging behind reality. Arbitrage windows always close, and they rarely close gently. We fully expect volatility to continue. We fully expect the banks to fight this move with everything they have, but they are not fighting traders anymore. They are fighting physics. They are fighting the flow of physical matter from west to east. The magnet at $93 is pulling the market upward, and once that level is reached, the next magnet is $100. But while the charts and global arbitrage explain the macro picture, something even more immediate is unfolding inside the United States, something that directly affects anyone trying to buy silver today. The paper price says $85. The street price says something very different. We have received confirmed reports from major U.S. bullion dealers that the physical supply chain has snapped completely. While financial television scrolls an 85.37 price across the screen, the reality on the ground is disconnected. If you try to buy a silver round or silver eagle today, you are not paying $85. You are paying premiums that rival the height of the pandemic squeeze. Premiums on standard silver rounds have exploded to between $8 and $9 over spot. Do the math. 85.37 plus a $9 premium equals 94.37. That is the real price of silver in America today. And notice something critical. That street price is almost perfectly aligned with the Shanghai price of 93.31. The physical market has already repriced. It has already crossed the $90 threshold. The only thing that has not caught up is the paper contract on the COMEX. The screen is lying. The receipt from the coin shop is telling the truth. But price is only half the story. Availability is the real crisis. Private mints, the companies that take 1,000-ounce industrial bars and turn them into coins and rounds, are now quoting 8-week delays on new orders. 8 weeks. This is not a shipping issue. This is not a logistics bottleneck. This is a manufacturing failure. It means the mints cannot source raw silver blanks. They do not have the metal. When a mint quotes an 8-week delay, they are effectively selling a futures contract. They are saying, give us your money today, and we hope we can find the silver to deliver it 2 months from now. That is a retail-level physical default. The inventory buffer that normally exists between wholesale supply and retail buyers is gone. It has been vacuumed up by panic buying in the last 48 hours. And then came the quote that says everything. A senior executive at a major U.S. bullion dealer was asked about inventory conditions this morning. His response was blunt. Nobody has any silver? He went on to warn that if momentum continues, silver premiums could reach $20 to $30 per ounce. Consider what that means. If spot stays at $85, but the premium rises to $30, the real price you pay is $115. That creates a bifurcated market where the paper price becomes irrelevant. The banks can smash the COMEX price all they want. They can print unlimited contracts and drive the paper quote down to $70. But if physical premiums rise to compensate, the cost to acquire metal does not fall. You cannot print silver eagles. You cannot short physical ounces into existence. This disconnect is existentially dangerous for the banking system because it exposes the fraud. It proves that the COMEX is no longer a valid price discovery mechanism. It is a casino for algorithms. And the public is waking up. The retail tsunami we warned about is here. Americans see the inflation. They see the debt. They see the instability. And they want something real. But when they try to buy it, they find empty shelves and massive markups. That triggers panic buying. In a normal market, rising prices reduce demand. In a shortage, rising prices accelerate demand. Buyers are not afraid of paying $95. They are afraid of not being able to buy at all. This is inelastic demand colliding with inelastic supply. The mints cannot increase production because they cannot get silver. Buyers will not stop buying because they no longer trust the dollar. Something has to give, and that something is the paper price. The COMEX cannot trade at an infinite discount to reality. If the spread widens enough, traders will stand for delivery, take bars at $85, and sell them to mints at $95. That arbitrage will drain COMEX vaults until they are empty. This is not opinion. It is mathematics, and mathematics always wins. So what should you do in an environment like this? If you are trying to buy physical silver right now, you are facing a difficult reality. You are paying historically high premiums. The moment you buy, you are technically locking in a loss relative to the paper spot price. That creates hesitation. It creates doubt. And that doubt is exactly what paralyzes people at the worst possible moment. But the real question is not whether the premium is high. The real question is whether the metal will still be available tomorrow. Is it better to pay a $9 or $10 in premium today and actually have the silver in your possession, or wait for the premium to drop and risk getting nothing at all? Because if industry insiders are correct and premiums push to $20 or even $30, then today Guinness price will look cheap in hindsight. This is what I call the Unobtainium Phase. At this stage, the sticker price becomes irrelevant. If the product is out of stock, price no longer matters. What we are witnessing is not a normal market correction. It is the early stages of a run, but not a run on commercial banks. This is a run on the resource bank. People are not lining up to withdraw cash. They are lining up to exchange cash for resources before those resources are repriced beyond reach. They are trying to get out of paper and into something real. The 8-week delivery delay is the tell. It is the signal that the system is operating at the edge of failure. If that delay stretches to 12 weeks or 16 weeks, the market effectively freezes. At that point, silver becomes no offer. You cannot buy it for any amount of paper money. You can only obtain it by trading other real assets: gold, land, labor, energy, or productive capital. We are not there yet. You can still buy silver today. You can still place orders, but the window is closing. The doors are already sliding shut. The dealer crisis is the canary in the coal mine. It is telling us that the wholesale market is broken. If the mints cannot get silver, the refiners cannot get silver. If the refiners cannot get silver, the miners are tapped out or constrained. The chain is fractured. And while the physical market is flashing red alerts, the chart continues painting its vertical masterpiece. Silver at $85, up nearly 7%. The paper market is pretending everything is normal, but the physical market, the market of premiums, delays, and empty shelves, is screaming that the system has failed. This brings us to the endgame. We now need to take the $93 Shanghai price, the potential $20, $30 retail premium, and map out where this move is actually heading. We need to understand what happens when silver crosses the psychological barrier of 100, and why that moment will trigger a global media frenzy that makes today AS panic look like a rehearsal. Most importantly, we need to discuss how to navigate a market where price and value are no longer the same thing. The dealer has spoken. Nobody has any silver. If nobody has it and everybody wants it, what happens to the price? You already know the answer. If you have followed this deep dive from the beginning, you now understand the full scope of the fracture. You understand the technical breakout on the charts. You understand the Shanghai magnet pulling prices toward $93. And you understand the dealer crisis, where the street price has already decoupled from the screen. This is not a trading anomaly. This is a systemic failure. The three pillars of price discovery, technicals, arbitrage, and physical supply, have aligned in a way we have not seen since 1980. And once an asset breaks into true price discovery, there are no maps. There are no resistance levels. There are no historical ceilings. We are flying into a vacuum. So where does this stop? Is $85 the top? Is $93 the top? Is $100 the top? To answer that, we cannot look at silver priced in dollars. The dollar is a broken measuring stick. Measuring silver in dollars is like measuring the length of a bridge with a rubber band. The rubber band is stretching every day, so the bridge appears to get longer, even if nothing has changed. Instead, we must look at relative value. We must look at silver in relation to gold. Gold today is trading around $4,600. It is up strongly and holding firm. It has become the anchor of the emerging financial system. Now consider the gold to silver ratio. Throughout monetary history, from the Roman Empire to the U.S. Constitution, the natural ratio between gold and silver was roughly 15-1. For every 15 ounces of silver in the Earth's crust, there's approximately 1 ounce of gold. In the modern era of financial manipulation, that ratio was distorted. It blew out to 80, 90, even 100-1. That distortion told us silver was being priced as a cheap industrial byproduct rather than a scarce monetary metal. But today, with gold near $4,600 and silver near $85, the ratio has collapsed to roughly 54 to 1. The ratio is reverting to the mean. Now ask the critical question. If silver simply returned to its historical monetary ratio of 15 to 1 against today's gold price, where would it trade? Do the math. $4,600 divided by 15 equals roughly 300 SAR per ounce. That is monetary parity. At $85, silver is not expensive. It is deeply discounted. It is trading at more than a 70% discount to its historical monetary value. This is the catch-up trade. The algorithms understand this. The central banks understand this. And when gold becomes too expensive for the average person, capital naturally flows into silver because it offers leverage and accessibility. Silver is not just the poor man's gold. It is the accelerator. This is why a move to $100 is not a question of if, but when. Shanghai is already at $93. U.S. street prices are already at $94. The paper price has no choice but to follow. And $100 matters, not because it is fair value, but because humans are wired to respond to round numbers. When silver crosses $100, it will dominate headlines. It will appear on magazine covers. It will lead nightly news broadcasts. That is the moment of maximum attention and maximum danger. Which brings us to the exit strategy. Many of you are already thinking about selling. You look at your stack. You calculate the dollar value. You feel wealthy. You imagine paying off debts or upgrading your lifestyle. Be careful. If you sell your silver for dollars, what are you actually doing? You are trading a hard asset that is appreciating for a soft currency that is collapsing. You are jumping off the lifeboat and swimming back toward the Titanic because the Titanic still has champagne. The dollar is not the destination. The dollar is the victim. We are not witnessing a reset announced by politicians. We are witnessing a market-driven reset. And the signal is not a bond auction or a press conference. The signal is the spread. When Shanghai pays $8 more than New York for the same ounce of metal, the market is screaming that Western price control is over. Every currency collapse in history tells the same story. From Weimar Germany to Zimbabwe to Venezuela, those who sold their gold and silver too early regretted it. They sold for millions of paper units, only to discover that bread cost billions weeks later. So when do you sell? You sell when you can trade ounces for income-producing hard assets. This is the ounces to acres strategy. Do not trade silver for paper. Trade it for land. Trade it for rental property. Trade it for businesses, energy infrastructure, or productive assets. Wait for the moment when mania peaks, when real estate collapses relative to silver. Today, it might take 5,000 ounces to buy a house. At the peak, it might take 500. That is the trade. You're not chasing dollars. You're converting one form of generational wealth into another, but we are not there yet. At $85, we are still on the launch pad. The week ahead will be brutal. Volatility will be extreme. Banks will attempt counterattacks. They will try to smash prices, spread rumors, and manufacture calm. Ignore the noise. Watch the flows. Is the Shanghai premium disappearing? No. Are mint delays improving? No. Is industrial demand slowing? No. The fundamentals are locked in. There's no return to $20 silver. That world is gone. We are entering the era of resource nationalism. Countries with silver will hoard it. Countries that need it will fight for it. And you, the individual investor, are standing in the middle, holding the one thing everyone wants. Do not let them shake you loose. Secure your position. Protect your assets. Educate your family. The great repricing is not about getting rich. It is about surviving the transition from a debt-based economy to a resource-based one. The dollar died on Sunday. Price discovery began on Monday. And the future belongs to those who hold physical reality in their hands. Stay safe. Stay liquid.